Ladies and gentlemen, good morning and a very warm welcome to Rathbones 2025 full year results presentation. Can I do the admin bit? Would you mind switching off your mobile phones, or somebody will be listening to me in Vladivostok or Abyssinia? So I'd be most grateful. I'm joined today in the room by our Senior Independent Director, Sarah Gentleman. Sarah, you're most welcome. And I'm joined online by other board directors. I'm pleased to see investors, analysts with us in person, and I'd like to say hello to the many more who are joining us online. I appreciate that you make the time, whether you are long-standing shareholders of Rathbones or are engaging with us for the first time. Today is an important moment in our calendar as a company, and on behalf of the board, I want to thank those shareholders for their interest and continued investment in our fine firm. We trade today at a 5-year high with our market capitalisation at over £2.4 billion. So let me set out briefly how we intend to run this morning. We will begin with an overview of the 2025 financial results and guidance from our Group CFO, Iain. Can you wave, Iain? Iain Hooley, followed by opportunities for question. Another form of health guidance. When you want to ask a question, please wait for the microphone to come so that our colleagues who are online can hear your question. Then, after a short break, we will move into the strategic presentation where our new Group CEO, Jonathan Sorrell. John, thank you very much. Glad everybody's recognised. Will outline a forward-looking evolution of our strategy, and we will close with a further Q&A session. Before we begin, I want to offer a few reflections from the board. Slightly tongue-in-cheek. It is the 284th year, so since 1742, since the Rathbones Group started in Liverpool. And I'm going to say, consistent with that long heritage, we have tried to deliver disciplined capital returns, including a 6.2% compound annual growth rate in our dividend in the last 20 years. This is a valuable and fine business. Today, we continue that tradition by announcing a dividend of 99p, which is an increase of 6.5% compared with 2024. Setting the maths to one side, this has been a year of meaningful progress for Rathbones. We completed the client integration of IW&I, a major milestone that provides the foundations for a unified and much more scalable organisation looking into the future. And I want to take a few minutes here to thank our colleagues across our group, 3,500 employees in 17 offices, to thank them for the work that they have done exceptionally hard in the last 2.5 years to get this done. This was never taken for granted, and I want to thank you, all of you, on behalf of the board. We navigated the CEO transition smoothly as a board and have strengthened the executive team considerably around John, adding further experience to support the next phase of growth. We also launched the group's first ever £50 million share buyback last year, reflecting our commitment to disciplined capital allocation, and this morning announced an extension to that of a further £20 million. We know who owns this company, and we reward our investors accordingly. And importantly, the executive team have defined a clear strategy for 2026 and beyond, one that positions the business for long-term success. This is about being in a marathon and not just a sprint. To echo the home team's stated ambition to be the best wealth manager in the UK by far. From a board's perspective, these achievements speak to a business that has strengthened its foundations whilst continuing to deliver for clients and shareholders. There is always more to be done. but the board and I are enormously encouraged by the momentum that is building across the organisation and by the clarity of purpose that now underpins the next stage of Rathbones' journey. Unrealistically, I look forward to the next 284 years. With that, I will hand over.
Thank you, Clive. Good morning. Thank you again for making it here heroically on a Friday, mostly in suits and ties. So thank you. We really appreciate it. And to those online as well, welcome. You're going to see a lot more of me shortly, as Clive outlined, but I just wanted to take a moment to introduce the new team to you all. And so I'll start with Brad, our new CTO. It's a newly created position at the company already since starting on the 2nd of January. Brad has injected huge momentum into our technology effort. I don't think I've ever seen anyone so high on AI, which is terrific to see. Next, Camilla, who I think some of you will have met already, who joined in June from some other company, but has just done an incredible job getting to grips with our front office team, and is full of Formula One analogies, which I take to mean it's all about incremental improvement and achieving excellence. Next, Cassandra. I don't think I've ever spoken to a CRO whose byword is hustle. So we thought that was quite a good place to start. But recently anointed by our regulator, Cassandra, making a huge difference, huge shoes to fill, of course, following Sarah Owen-Jones, who's done such a fantastic job for us for such a long period of time. Gillian, another with big shoes to fill, following Gaynor, and I'm sure delighted as our new head of HR, our CPO, to be walking in just when compensation is being done, which is the favourite part of any CPO's calendar. So welcome to Gillian. Iain, we're all bored of. Ivo, one of the legends of our business, I will say, 33 years young in the business. I think 11 years on Exco, and a font of huge knowledge, institutional knowledge, experience on both the investment side and the wealth side, and also the founder of our charities business as well, a huge generator of our business. So Ivo. Moving on to Jane, who is Executive Chair of Rathbones Asset Management, and really in the last couple of years as well has revolutionised our approach to distribution in the business, both in terms of business development on the wealth side, but in RAM as well, and really excitingly for Rathbones as a group. And there are many situations where we can bring the best of Rathbones to a client situation, and Jane does that in spades. Mike, our Chief Operating Officer, has had the huge misfortune to have worked with me in the past at Man Group, and used to be Chief Executive of Man Solutions. We have a really broad agenda of very important strategic projects that need to be delivered as a group. And Mike is going to sit at the apex of all of that and make sure that everything is, I think you promised, to be delivered on time, on budget, and perfectly and beyond expectations, which was good to hear. Robert Sears, who will join us on Monday, not here today, is our new CIO. Tremendously excited about what he will bring from all of his experience in the family office world to our business. And last but not least, the force of nature that is Simonetta, who has brought an entirely different dimension to our brand, to our marketing effort, whether that's digitally or indeed in other forms. And we are very, very excited about what we have to come on that side as well. So with that, I will let Iain get on with the good stuff. Please do stay around in the coffee break and after today's presentations to spend some more time with the team.
Thank you very much, John. And good morning, everyone, and welcome. I'm going to cover three main areas. First, I'll run through the overview of the 2025 results. I'll then cover figures relevant to the IW&I integration and our capital position. And I'll then conclude with our expectations for margin progression and performance in 2026. So I'll begin with covering the main financial highlights for 2025. Funds under management and administration, or FUMA, increased by just under 6% to £115.6 billion at the 31st of December, reflecting the recovery in asset values from the low point at the end of the first quarter, when FUMA fell 5% following the announcement of the tariffs by the US government. Operating income grew by 3.1%, with all principal income streams growing year on year, benefiting from both higher average FUMA and the realisation of synergies. The rate of growth in income is lower than the overall growth in FUMA, as investment management fees are crystallised on a quarterly basis, with the first billing of the year coinciding with the low point in FUMA at the end of the first quarter. Underlying profit before tax grew 4.6% to £238.1 million. That was supported by the continued delivery of synergies, which reached £76 million on an annualised run rate basis during the second half, following the migration of the ID&I clients onto the Rathbones operating platform. The underlying margin increased to 25.8% for the year overall. This reflects a margin in the second half of the year of 27.5%, having recovered as expected from 24% for the first half. On a statutory basis, profit before tax grew 53.5% to £152.9 million, having also benefited from a reduction in integration costs. Underlying basic earnings per share increased by 5.5% to 170.5 pence per share, in line with the growth in underlying profit and supported by the share buyback. We've proposed, as Clive referenced, a final dividend for the year of 68 pence per share, which brings the total dividend to 99 pence, an increase of 6.5% relative to 2024. And that's reflective, of course, of our progressive dividend policy and is underpinned by the growth in earnings. We'll now look at the principal movements in underlying PBT between 2024 and 2025 and their impact on the margin. The benefit of synergies increased as the full benefit of those delivered in 2024 came through during the year, and synergy delivery then increased further during 2025. Whilst FUMA ended the year at £6.4 billion higher than it began, the average level of FUMA during 2025 at the points when fees are calculated was a more modest £3.3 billion higher than the average for 2024, reflecting the market volatility we experienced in the early part of 2025. Profit growth driven by the level of FUMA was therefore limited to £13.4 million. Recurring costs increased as a result of inflation and the specific headwinds we've signposted previously. Non-recurring costs incurred in 2025 comprise those we've communicated before, which include the effect of transitioning to the technology outsourcing agreement with Investec and the effect of executive changes. You'll have seen our flows position previously in our fourth quarter trading update, so I'll just touch briefly on the main points. Within the wealth management segment, gross inflows remained resilient at 9.5% of opening FUMA. That's despite the focus required from investment management teams on client migration, which took place during the first half. Gross inflows were then £0.7 billion higher in the second half. Gross outflows improved relative to the prior year, though they were higher in the second half, driven in part by an uptick ahead of the UK budget in November. Net outflows for the fourth quarter were the lowest quarter of the year at £64 million, being 8% of the total for the year. As we moved into 2026, we've seen higher than normal outflows relating to payments of tax to HMRC from portfolios ahead of the 31st of January tax payment deadline. The elevated level of tax-related outflows persisted only for the month of January, and it is consistent with the increase in clients choosing to crystallise capital gains ahead of the UK government's first budget back in October 2024. These tax-related outflows present some further distortion that we've seen in flows, the flows picture over recent months, adding to that caused by the November budget. In addition to those specific distortions, flows of the wealth management segment are also subject to movement in charities mandates, which behave in a more institutional manner, and flows relating to non-core execution-only services, which are inherently more volatile. These factors affect the overall headline level of net flows for the wealth management segment. Looking through them, we remain focused on the FUMA and flows that are the core drivers of our overall profitability. Delivering improvement in flows relating to the core discretionary private client FUMA is where our focus is strongest. Our strategy to improve these flows is focused on creating the conditions within the business that will support growth and pursuing specific growth opportunities, and John will talk more about that later. With regards to asset management flows, the asset management segment continues to operate in a very challenging environment for UK asset managers, particularly in relation to single strategy funds. However, it's important to recognise the areas of underlying strength within the asset management business. Performance across several flagship strategies remains competitive, and our investment teams have deep experience through market cycles. During the year, the asset management business launched 2 important new strategies: a Charities Authorised Investment Fund, or CAIF, and an ex-Japan Asia Fund. And whilst those funds are in their early stages and therefore had a limited impact on the flows position for the year, they nevertheless represent important enhancements to our asset management offering. The asset management segment provides the investment solutions to certain of our wealth management propositions, principally the Select and Manage services and the core MPS service, which launched during the year. And John will speak more later about how Rathbones Asset Management enhances our overall competitive position. But the funds under management managed by the asset management segment that relates to the services of the wealth management segment is included in the gross FUMA of each individual segment and is then removed from the asset management segment in order to show the consolidated group position. And that's on the intra-group FUMA line towards the bottom of the table. We'll now look at the breakdown of income for the group. All principal income lines reported growth relative to the prior year. The growth in fee income reflects the higher average level of FUMA. Commission income benefited from higher transaction volumes as markets recovered and activity increased ahead of the November budget. The increase in net interest income includes interest relating to cash balances on IW&I portfolios being recognised on this line following migration, prior to which it was recognised within other income. So the other income line therefore shows a corresponding reduction. The increase in net interest income also reflects income synergies realised as a result of the higher net interest margin generated by Rathbones' banking model relative to IW&I's client money model. The reductions in the UK base rate that have arisen so far have had a relatively limited impact on the net interest margin due to margins on deposits being maintained so far, and the effect of the group's treasury investment strategy, which has a delaying effect in terms of how quickly the base rate reduction feeds through to our net interest income. On advice revenues, those increased as we look to increase the portion of our overall client base that receives the advice services in addition to investment management services. We'll look now at income margins. The margins shown on the slide are based on gross FUMA of the relevant segment, i.e. prior to group eliminations. All revenue margins have shown resilience, with both fee and commission margins for the wealth management segment increasing year on year. The asset management fee income margin has shown some decrease as the mix of funds continues to shift more towards multi-asset funds, which have a lower annual management charge relative to single strategy funds. Our treasury income yield, which is based on the total value of the group's liquidity, increased from 225 basis points in 2024, reflecting the margin on deposits being maintained, as I touched on earlier, following the recent base rate reductions, along with that benefit of our treasury treasury investments profile, which means that interest received is not immediately impacted by reductions in the base rate. Turning now to synergy delivery in relation to the IW&I integration. Synergies delivered at the 31st of December 2025 amounted to £76 million on an annualised run rate basis. That significantly exceeds our target of £60 million and is delivered well ahead of the September 2026 target date we originally set at the time of the transaction. Synergies delivered during the second half of the year have been driven predominantly by the decommissioning of the IW&I operational platform following migration of IW&I clients onto the Rathbones platform. With the synergy target exceeded and the integration now complete, we consider 2025 to mark the end of the period of synergy delivery relating to the IW&I integration. However, cost discipline remains the highest of priorities, and we continue to see some opportunities for further efficiencies to be achieved, which we will deliver during 2026 as we optimise the operating platform, systems and processes. We'll now look at those costs which are recognised as non-underlying costs. The categories of those costs which are recognised within non-underlying is consistent with prior years. Amortisation of intangible assets of £45 million reflects the continuing run rate for that cost line. IW&I integration costs reduced significantly relative to the peak in 2024. We will continue to incur costs relating to the integration of IW&I up to and including 2027. Those costs that will be incurred in 2026 and 2027 mainly relate to share-based awards that are expensed over the vesting period, which related to the integration. Taking into account the costs relating to those awards that will recognise, part of which gets recognised directly in reserves at the time the awards actually vest, and the elements of property-related integration costs that were funded by Investec, we continue to expect the total integration costs to remain within our original guidance of £177 million. Our effective tax rate for the year of 26.6%, we expect that to remain around that level during 2026. So I'll now move on to look at our capital position. Managing the group's capital in a disciplined and efficient manner is of the highest importance to us. We announced our capital allocation framework last year, which sets out our approach to deploying capital. Delivering organic growth and returning to positive net inflows of FUMA is our primary objective. The decisions we make to invest in the initiatives that will support organic growth are assessed with discipline to ensure they are fully aligned with our objectives and will deliver the appropriate return above our cost of capital. Given the importance and focus we attribute to organic growth, the threshold for investment in inorganic growth is currently very high. We maintained our progressive dividend policy and have announced today the proposed increase of 6p to take the total dividend to 99p. Over the past 20 years, as Clive referenced earlier, the annual growth rate in our dividend has been over 6% per annum. The dividend in 2025 will be fully covered as a result of the increase in statutory earnings, which reflects the reduction in integration costs. 2 weeks ago, on the 16th of February, we announced the completion of the buyback of £50 million of share capital, which was the first buyback we've undertaken. The group remains highly capital and cash generative, with profit converting to cash over a relatively short cycle, and the rate at which capital will be generated going forwards has increased as synergies have been realised and the level of integration costs reduces. So consequently, with adequate capital to support our investment in organic growth, we have today announced an extension to the initial buyback programme, and subject to regulatory approval, we'll undertake a further buyback or an extension to the buyback of £20 million of shares. Looking now into 2026, I'm going to set out our guidance in three main elements. First of all, in terms of our overall margin and how we expect that to progress over the course of 2026. I'll then cover our expectations relating to specific income streams, and finally, I'll cover aspects of our cost base. So the guidance this year is more detailed than I would normally set out, but I feel that's necessary in order to explain what is a relatively complex picture as we move out of synergy delivery and invest in strategic priorities and maintain our focus on continuing to improve the efficiency of the cost base. In overall terms, whilst these factors put some downward pressure on the margin in the first half of 2026 relative to the run rate at the end of 2025, we ultimately expect to achieve our 30% margin target in the fourth quarter of 2026. So I'll begin with our margin guidance for 2026. I set out this time last year the path to a 30% underlying operating margin that took into account the additional cost headwinds that had arisen since the 30% margin target was first communicated at the time of the IW&I transaction. The path showed synergy delivery increasing the margin to 28%, with the remaining uplift to 30% dependent upon organic growth in FUMA. The path was also underpinned by the assumption that the impact on the margin of cost inflation would be offset by market-driven growth in FUMA. Whilst market appreciation has offset the impact of inflation and synergy delivery has exceeded the original target, those benefits have been broadly neutralised by net outflows during 2025 and the additional cost headwinds we communicated with our 2025 half-year results, along with our continuing expectation of a reduction in net interest margin as the base rate falls. Taking all those factors into account, we remain on track to deliver a 28% margin in Q4 as a result of synergy delivery, and we continue to expect to deliver a 30% margin from the fourth quarter as a result of further cost efficiencies that we have identified and will deliver through continuous improvements in systems, processes, and our operating model. The achievement of a 30% margin from the fourth quarter of 2026 is based on growth in FUMA of 3% during 2026, stable inflation, and interest rates being in line with current market expectations. We expect the margin in the first half of 2026 to be notably lower than the second half, reflecting the one-off investment we will be making to consolidate our client lifecycle and relationship management systems using Salesforce and Xplan, which will replace InvestCloud. That will increase the first half cost relative to the prior year by £9 million and by £7 million for the year overall. We expect the margin to show significant progress during the second half as this investment is completed and the benefit of further cost efficiencies begin to come through. We expect the overall margin for 2026 to be broadly consistent with the second half of 2025 being in the upper 20s range. And that margin guidance takes into account all movements we expect to see in income and costs during 2026, the more significant of which I'll now just briefly cover. Within our income streams, fee income will of course be dependent upon the level of FUMA, which started 2026 significantly higher than the average for 2025. Commission income is expected to be around 5% lower than 2025 as volumes normalise following the heightened levels of activity in 2025 that I've referred to earlier on. Net interest income is expected to be broadly flat year on year, and that's the net effect of three factors. First, a reduction in the income margin as the effect of recent base rate reductions flows through fully, along with the effect of further rate cuts that are expected during 2026, for which we're assuming the UK base rate will be 3.25% by the end of the year. Secondly, we'll see a full year of the synergy benefit resulting from IW&I's client money balances moving on to the Rathbones banking model. And thirdly, the recognition of a full year of interest income on the net interest income line relating to the IW&I business, which was recognised within other income prior to migration. And with regards to advice income, we expect to see a similar rate of growth as we've seen in 2025. We continue to see significant opportunity for growth in our advice revenue. And whilst we expect to see that, greater momentum is expected once we've established closer alignment between our investment management and advice offerings during 2026. Costs in 2026 will benefit from a full year of synergy delivery, bringing an additional £16 million of benefit to 2026. Expenditure to support our strategic objectives includes the investment to consolidate our client lifecycle and relationship management systems, which I touched on just earlier. We have also expanded our change capacity in 2026 as we look to accelerate the continuous improvement of our systems and processes. Staff costs are expected to be around £10 million higher in 2026, driven predominantly by inflationary salary increases. The new client-facing remuneration scheme for the combined business was implemented within the existing level of cost but did involve some rebalancing of fixed to variable costs, fixed to variable remuneration, as we achieved alignment across the combined business. Inflation will, of course, continue to affect non-staff costs, but we do not currently expect to see a significant increase in the FSCS levy. Integration costs, which are reported within non-underlying costs, are expected to be significantly lower in 2026, at around £17 million for the reasons I covered just earlier. So I appreciate the guidance. That guidance has covered a lot of ground. So I'll finish by just coming back to the main point, which is that whilst there are factors that will influence the level of the margin over the course of the year in 2026, based on our assumptions relating to FUMA, inflation and interest rates, we remain on track to reach a 30% margin in the fourth quarter of 2026. And with that, John and I will happily take your questions. Thank you.
Hi, it's Ben Bathurst from RBC. I've got questions in 3 areas, if I may. Starting with FY26 guidance. Lots of moving parts, clearly. But with synergies now secured, what do you expect to be the equivalent of that 31 million PBT benefit that you show on slide 8 for 2025? What do you expect to be the equivalent for FY26? And then secondly, on capital, as you mentioned, integration costs behind you, you should be more capital generative looking forwards. Should we consider further future buybacks as highly likely? And then just on the sort of the capital position at the year end, 108 million, I think, after the buyback screens are slightly high. Are you holding back something there potentially for bolt-on activity? And then just finally, on the Salesforce versus InvestCloud decision, what are the benefits that have really informed your decision to invest again and incur that incremental cost? Thank you.
Thanks, Ben. So taking those in turn then, so the synergy benefit for 2026 will be £16 million. So that's effectively the full year of the 2025 synergy delivery coming through in 2026. So that'll be an additional 16. So that's in the guidance. In terms of the buyback, the reason we've gone for an additional £20 million is because we could accommodate that within the existing programme. And the existing programme doesn't involve Investec participating. So as we buy shares back, that concentrates Investec's holding back to closer to where it originally was at the time when the transactions happened. Not beyond that, of course, but up to that level. So it was simple to bolt that on and accommodate within that existing framework. If we want to go beyond that, things get a little bit more complicated. We need to go through a process to agree how we would manage that process of Investec's participation. So we continue to apply our capital allocation framework. We're fully committed to that. To the extent that we have capital that goes beyond our investment needs, we will continue to return that capital to shareholders. So we're not setting that out as a hard and fast rule, but you have our assurance that that's the discipline that we are very much focused on. I think that hopefully covers that capital question. Is that right, Ben? Yeah. On the CLM, the capital, the InvestCloud decision. I mean, I think ultimately we implemented InvestCloud to replace to be our client lifecycle management solution. I think it's fair to say it hasn't delivered everything we wanted it to. We've got some marginal benefits from it, but we see greater opportunity in moving on to the Salesforce system, given the strategy and the focus on organic growth and building the foundation that will enable us to that will support that growth. So that's behind our decision to do that. And we feel we can implement that during the first 9 months of 2026. We've got Brad and Mike who are involved in that execution and very much focused on that. We already use Salesforce and Xplan in the business, so we have a high level of confidence that those will be readily implementable within that time frame.
Hi, this is Christiana Holstein from Bank of America. I also have 3 questions. So firstly, maybe on net flows. So I know gross inflows started to improve towards the end of last year, but it still does seem a little softer following the IW&I integration. So just wondering what your expectations are there. And then if the guidance for 3% per annum growth for FUMA, does that imply expectations for still net outflows in 2026, or how are you thinking about flows versus performance there? My second question is also on the client lifecycle and relationship management system. So I understand with the whole shift in technology systems previously through IW&I, that did impact IM productivity as they got used to the new systems. Could there be any potential for productivity impact here as well, or just a teething process? And then my third question is on advice. So previously this was quite a very exciting part of the business and potential for future growth. Just wondering how you're thinking about that now with risks for AI being front and centre, and then how advice also now contributes to the margin target. Thank you.
Shall I take some of this? Yeah. Thank you. So look, on flows, traditionally we wouldn't comment on an outlook for flows specifically. The job now, as we'll talk about later, is to generate sustained net inflows going forward. I wouldn't read anything into that 3% FUMA beyond we're giving you a framework to think about what needs to happen in order to hit that margin target in Q4. And we're confident on the basis that Iain laid out with respect to FUMA growth, whether that comes from flows or the market this year, and then what happens to interest rates and inflation. On the CLM system, you're right. I think the implementation of InvestCloud had an impact on IM productivity. The good news about moving to a solution that really combines Salesforce and Xplan is that those are two systems that are already part of our business, and so people are to a greater extent used to them already. But of course there will be some friction on the implementation of any new system, but I wouldn't expect it to have the same magnitude of impact that we saw with InvestCloud. And then with respect to advice, not to steal any thunder from what's coming later, but it's just to say it is a very exciting opportunity, and with respect to AI, we see just potential huge benefits in terms of the productivity that will bring. And AI won't obviate the core of what our value proposition is to clients, which is trust and empathy and judgment. And you can take what AI brings you and add those elements and indeed spend much more time on them.
Morning, it's David McCann from Deutsche Bank. I'll stick with the traditional three as well, please. And we'll start on that 3% again, just to follow up on that previous question. So I obviously hear your comments. You're not going to comment on the flows and what we may or may not be able to read into that 3%, but should we better think of this as that's the minimum level you need to get to 30%? So presumably if FUMA growth was more than 3, we should expect more than 30. That's the first question. Secondly, what is the dividend policy or payout ratio or growth, however you're thinking about that going forward? That would be useful. I think traditionally you've steered us in the direction that it's like a 2/3 payout ratio, but maybe that's no longer the right way to think about it. So yeah, that would be useful. And then finally, the investments you're talking about, is all of this going to be OPEX or is some of this CAPEX?
Okay, so just on the 3%, I mean, we've just made that assumption within there, and if FUMA grows, but from whatever means by 3%, then we will hit that margin target. I mean, clearly we've got opportunities to invest as well as letting if any further future benefit if there is a further growth beyond 3%. But that we think is a reasonable basis on which we can deliver that 30% margin target. On the dividend, we don't set a payout ratio as such, but our dividend policy remains progressive, and you can see from our track record how that progression has played out over the years. It's all part of the capital allocation framework, so to the extent that we generate more capital and there's a headroom between the dividend and total capital we're generated beyond what we need to invest in the business, then we will continue to return that surplus to shareholders. And OPEX, yeah, in terms of the investment in the strategic initiatives, yes, we don't envisage that being capital investment as such. We can see that being accommodated within our existing cost base. It's really about reprioritisation of things. We can achieve further synergies in certain efficiencies in certain areas and redeploy that capital to areas that will deliver a better return. And that's all part of our capital discipline that we apply to all of our decisions, that we want to make sure we are deploying capital and resources in the right place that delivers the right return.
Morning, Jacques-Henri Gollard, Kepler Chevreux. Just one really. Thank you very much for the guidance on the operating margin, super comprehensive. But at the end of the day, if there is growth, is it worth remaining married to it? And would you remain married to it come 2027 if the momentum of the business is actually good? And why not spend more money for one given cent of growth? Thank you.
You only had one question. Yes. It's unheard of. Look, the 30% margin target is for Q4 of this year. I think your point more broadly, longer term, is exactly right. I mean, what impacts our margins? Obviously, some things are beyond our control, market movements, so on and so forth, interest rates. I've received much feedback from shareholders that one shouldn't marry yourself to a target long term when there is growth to be had. So I'm sure we'll have a sensible discussion about that going forward. But the 30% target pertains to Q4 of this year, and on the basis that Iain laid out, we're confident of hitting that target. Okay, any more questions? Perfect. Well, we're going to allow ourselves a 10-minute break, if that's okay. There's coffee outside, and if we could be back in here for 10:51, let's call it 10:50, 9:50 rather, 9:50, that would be great. Thank you.